Well, hello everybody. Welcome back to the Money Management webinar part 2. All right, now this is going to be a short session, not a very long session, but it's all theory, no charts on this time. But just to let you know, to compensate for the technical analysis part of it, what I have done is I've prepared another small video on some live setups that we've taken based on the techniques that we follow. So it's going to be another video which I will be putting up, and I'll probably send it out to you guys, and the short video which will include this money management policies also. But let's just go ahead with this, right? Money management part 2. We're going to be talking about position sizing, leverage, margin, how they are interconnected. Now, for those of you who have missed out on the money management part 1, I have put a link at the end of this presentation. So you can always go back and check the YouTube video. If you want the PDF, the document of that, send me an email. I'll send you the document also. That's fine, no, not an issue, right? So let's start off with this now. When we were doing the part 1, there were a lot of questions on not just on position sizing, but also the correlation between leverage, margin. What is the correct amount of leverage that a trader should use, and how do you correlate margin with that? So this is important. And I thought it would be good to make a presentation just to clarify things. I mean, a lot of you are traders, of course, you're quite familiar with these concepts, but just for those people who are still a little confused about the concepts of leverage and how to use it correctly, let's just go ahead with this. Right. So in continuing with money management, continuing with the risk management, and the two golden rules which we discussed last time, we just go over it again. So previously we discussed the first golden rule in the previous webinar, which was the risk to reward ratio, and the importance of the risk to reward ratio vis-a-vis the win-loss ratio, which was the earlier session. And like I said, you can get the link to it. Now, this session, the second part, will be going over the second golden rule, that is position sizing. It simply means what percentage of your capital should you be risking on each trade. It becomes very, very important. So money management is a very crucial factor in the success and failure of trading, and especially in Forex, because high leverage is very freely available in Forex. It's one of the markets, in fact, I think the main market where the use of leverage can really go high. A lot of brokers they do give you very high leverage. And while it can be an advantage, it often turns out to be disadvantage because, as they say, it's a double-edged sword. So we'll be going over some figures, simple mathematical formulas to decipher the correct use of leverage, relation to the usable margins, which will correlate to the second golden rule of risk management on how much of capital should you be risking on each trade. Let me start with the concepts which I always discuss, which was in the previous webinar also, that as a trader, you're not looking only at technical analysis to succeed in trading. You're not looking at charts and trading systems only. You have to incorporate the 3 M's into your trading system, into your trading plan. The 3 M's are money, mind, and method in that priority. So if you distribute these on a scale of 1:10, money, your risk management policies will take up 5 parts out of 10. Your mind factor, which I simply call as patience and discipline, will take up 3 parts out of 10. And the method, the trading systems that everybody looks at, will take just 2 parts out of 10. Right? So you see, method is the least important part of trading. While of course this does not undermine the importance of technical analysis or fundamental analysis, whatever you may be using to analyze your trades or your trading systems. The fact is that these techniques must be combined with the other important factors of money and mind. And the retail trader, novice trader, the new trader who generally comes into the market, does not really understand this concept. And when the new traders, when they follow methods, most of them look at indicators, because that's what most trading systems tend to talk about, which means out of the 10 parts, a new trader is following, I would say, only 0.5 parts. And it's not surprising why the retail trader tends to fail. So coming back from the 3M's to money as it is on a priority, we'll be discussing the mind and method a little towards the end, but concentration more on money. So we are here to make money from the markets. Obviously, that's what you're trading for. So what should your priority be? And this is what I always tell my traders, that when you're trading, your first job is of a money manager. You have to conserve your capital because that's your bloodline. You don't have money, you cannot trade. It's just as simple as that. So trading of capital is the utmost important thing. But this is not just a simple process of keeping the risk limited. I talk to traders and say, okay, I do keep my risk limited, but there you must have a set of money management rules which will help you grow your account in spite of having losing trades, which you will. You'll definitely have losing trades. So there are two basic and simple rules of risk management that I speak as the two golden rules of risk management. If a trader simply follows these two rules, it can actually help put the trader into the top 10% winning bracket of all the retail traders. So the two rules are, one is the risk to reward ratio. You must have maintain a minimum risk to reward ratio of 1:2, which is what we discussed in the previous webinar. The second is the correct position sizing, which we'll be talking about today. You should not risk more than 1% of your capital on any single trade, one trade. Now this can be stretched to a maximum of 2% for retail traders like us. That means you can have two open trades at any given time, each with a risk of 1%. Remember that you can't have each with a risk of 2%. So taking this a little further, the importance of the risk management rules. You could have a very very effective trading system, but if your golden rules of risk management are not followed, your account has little chance of growing. On the other hand, if you just follow these rules of risk management, any kind of system you would follow, it actually takes a secondary priority. Your account would still grow. And I often joke about this, like I say, that if I have my rules of risk management in place, I can trade with the toss of a coin. No, heads I buy, tails I sell, and yet my account can grow. But then we are not here to do that, right? We are not here to gamble. We are here to trade. So coming back to the position sizing, this simply means risking a very small percentage of the trading capital, which enables the trader to sustain small losses while maintaining the account growth. Now, this can be correlated directly to leverage, because as I said, high levels of leverage are available in Forex, but leverage can be a double-edged sword. So while the use of leverage can increase profitability, it also puts the account at risk. So your correct position sizing is very, very important. It's the difference between growing your account and blowing your account is what I always put it as. So let's start with leverage. Let's have a look at the concepts of leverage and margin, right? So what exactly is leverage? Definition: you use a small amount of one thing to control a larger amount of something else. Now, in the financial markets, your leverage refers to how many times you're leveraging your money when you open your trading positions. So leverage can allow strong potential returns, but can also return significant losses when not used correctly. Going to the margin. Leverage and margin are correlated. In fact, they are inversely correlated. So when you utilize leverage, effectively what you're doing is you have a small capital, but you are controlling a larger amount of position with your small capital. So effectively the broker is lending you this money to take large positions. Now obviously the broker needs some security for the funds that he lends to you, and thus a certain amount of capital is blocked for that particular trade that you're taking, which is known as margin. Now remember two very important points in this. So this margin is a kind of a security deposit kept aside by the broker for the duration of the trade only. So once your trade is closed, this margin comes back to your account regardless of whether your trade is a win or a loss. So it doesn't matter, it doesn't affect your margin amount. This margin comes back. So it's a security deposit kind of thing. It's your money, is just blocked for some time. And second, of course, if you do not utilize any leverage, there'll be no margin kept aside. If you just take your positions. It's like you buy shares, right? You go into the market, you buy shares, you physically you pay for, let's say the share of one company, it costs $5,000. You want 100 shares, you would actually go up and pay about $50,000 for that. So you're not utilizing any leverage, you're putting it cash front. You can do that in Forex if you want, but obviously people don't do it because it requires a larger amount of capital. So remember, one another important point is that whatever leverage is available to you, you can reduce it. Right? If your broker is giving you some leverage, you can say, I don't want it, and you need to reduce it. The broker has to reduce it. He cannot increase it as per the laws or the country that he's operating in, because there are certain laws of maximum leverage which a broker is allowed to give to the trader. But it can be flexible. So don't think that whatever the leverage your broker is giving you, you have to use that. In fact, what I'm going to do is relating to the second golden rule of risk management. We'll find out a nice way where you can utilize this leverage, but at the same time, not risk your capital too much. And we'll come back to that. So margin, now there's a mathematical formula for that, right? How much of margin is kept aside for every trade? So it is whatever is the rate of the currency that you're trading, whatever the current rate that you traded it at, into the lot size, how many lots are you trading, divided by the leverage that you're using. So let's take the example. Let's say I have an account of $10,000. And if I'm utilizing a leverage of 10 times, right? So if I'm buying 10,000 euro USD. So 10,000 units is one mini lot, as we call it. And this is a current rate is 1.0450, just as an example. So if you calculated, the margin kept aside by the broker for this particular trade will be $1,045. Now see, this is important for somebody. Let's say I have an account of $10,000 as a risk, and a margin of 1,000 is kept aside. So 10% of my capital is blocked up over here. Now, for a retail trader who comes in, already a retail trader, most of them don't have very large capitals, because they've been told that with Forex, you can start with small amounts of money and you can grow it. So most people generally don't tend to take large capitals. They'll trade with small capitals. And in the small capitals, if almost 10% of your entire capital, depending on how much you're trading, is blocked up, then it becomes an issue. So the retail trader says, if I've got so much money blocked up, how am I going to take more trades? So this is where the retail trader goes and takes a larger leverage, which is available, right? So the same example, if I have a $10,000 account, now if I utilize a leverage of 50 times instead of the 10 times of the previous example, then as per the calculation, my margin is only $200. So only 2% of my capital is blocked up. This makes me very happy, right, as a retail trader. So the use of margin or the use of leverage, the amount of margin, can be correlated to the trader's capital. So if the account equity is small, the trader tends to use a higher leverage to reduce the margin amount which is going to be blocked, which will enable the trader to take more trades, each with higher leverage. But again, remember one thing, very important point. So if I utilize a leverage of 50, I am leveraging every move in the market by a factor of 50 times. A 1% move in the currency that I'm trading would equal a 50% move up or down in the account equity. Now, your profits can also grow, but most likely your losses, because you have kept a control loss, you've kept a stop loss, and I'm assuming you've kept a stop loss, your losses can grow exponentially. So utilizing the correct leverage becomes very, very important. Right, so what would be the proper use of leverage? So there's a very strong relationship between leverage and the impact on trader profitability. So the greater the leverage, the greater the swings to your account equity, as we just talked about. The smaller the leverage, obviously the smaller the swings. Most retail traders again look at higher leverage, saying that if I do make a profit, my swing of the profit as per leverage will be smaller. So I would want to utilize a higher leverage, unknowingly going into the factor that your risk is also growing larger. Right, so access to a high amount of leverage does not mean you have to use it. In UK, for example, your maximum leverage trade, I think it's restricted to 50 times. The FCA restricts it to 50. In the US, the SEC restricts the leverage to, again, I think it's 50 or maybe even 30. There are countries, there are brokers who are registered in, tax havens like Cyprus, Malta, and you have brokers in Southeast Asia. I mean, I keep going to Jakarta where I have my branch office over there. I have seen brokers giving leverage of up to 500 times. And I have seen traders utilizing those leverages, and I have seen them blowing up their accounts in one day. And I'm not joking, blowing up your account in one day. So your broker can offer you, as per the laws of the area that he operates in, he can offer you a high leverage, but you don't have to use all of it. You have to use leverage based on your own risk factors. So what is the appropriate amount of leverage? Now, conservative traders or professional traders don't utilize of leverage more than 3 times. Aggressive traders, professional aggressive traders, will probably go to 5 to 10 times leverage. And quite honestly, leveraging over 10 times, 10 to 1, should be avoided because it can actually lead to a very large and quick drawdown in the account equity. So this is one chart which, as I said, I'll send this document out to you. You can go through it. But what you can see over here is a trader A who is utilizing a leverage of 50 times, trader B who's utilizing a leverage of 5 times. The loss of equity for the trader A who is utilizing 50 times, he will have a loss of 50% of the account for a drawdown, whereas a trader B who uses 5 times the leverage will have a drawdown of only 5% in your account. And as I always say, don't look at your profits. Control your losses. Your profits will always come. As a trader, when I take a trade, the first thing I always look at is, if this trade goes wrong, which it does, which it can, what is going to be the loss in my account? And how am I going to sustain that? I don't look at the profits. Profits depend on how I manage the trade, if it goes in my favor, how I can utilize the entire trade. But your first priority is control your risk. Keep a watch on your risk, the profits will come. And I often say that. Now, this is a chart which I picked up from the Daily FX website. I mean, they have some excellent resources over there. So they have a section, they have a blog kind of a thing of traits of a successful trader. This is very relevant. Have a look at this. Percentage of profitable traders grouped by the effective leverage that they use. It's just based on statistics on how many traders have been trading, leverage they use. You can see 40% of the traders who are using a leverage of less than 5 times, the profitability figure is in the range of 40%. So you have traders, about 40% of the traders who use lesser leverage. The lower you go down, this figure, this people who use a leverage of more than 25 times, the profitability statistics go down. There's only 17%, sorry, of the traders who would probably succeed. Right, so this actually gives you a pictorial evidence that use of high leverage is not beneficial for your account. It is more harmful than beneficial to your account. So coming back to the golden rule of risk management, the second golden rule, that do not risk more than 1% of your account capital. Now, if I utilize 1% of my capital of any individual trade, effectively, if you do the math based on the margin calculations that we just went over, you can do it yourself on your account that you're trading. It brings the leverage down to 5 to 10 times, between 5 to 10 times, or leverage of 5 of leverage to 10, depending on the currency that you're trading, the value of the currency. So you see, if you just follow this golden rule that don't risk more than 1% of your capital, you're automatically getting your leverage in place. And here, what you can do is you're taking advantage of this fact. So let's say my broker is offering a leverage of 100 to 1. I mean, the trader that I'm the broker that I'm trading with does give me a leverage of 100 to 1. So if I take that leverage of 100 to 1, that means I am reducing the margin that I'm keeping with the broker. So I'm utilizing that factor. My margin is reduced. At the same time, I am not risking more than 1% of my account. So I'm controlling my leverage. So you see, I have the best of both the worlds. So use the leverage that your broker gives you. Take advantage of the lower margin, utilize that leverage, but at the same time, do not risk more than 1% of your capital on any trade. If you strictly follow this rule, believe me, it will be highly beneficial to your account. Now, this is the secret sauce, if you can call it. And believe me, I know traders who do that. I have known traders who have gone through this. Just have that mind factor, is what I call as a discipline, that I will not risk more than 1% of my account. And my first rule of golden risk management, I will ensure that I will have a risk to reward ratio of a minimum 1:2 for every trade that I take. Expected risk to reward ratio. Once you take a trade, obviously it may work out, it may not work out. But before taking the trade, if I know that my profitability as compared to my risk is about 2 times, I'm going to take the trade. If it's not, I will not take the trade. Right? So this comes to your mind factor. And I always say, so we've talked about the money factor. The mind factor is simply discipline and patience. Right? Besides having the discipline of saying that unless my two golden rules are met, I am not going to trade. It takes a lot to do that, believe me. There's also the psychology of trading, which accepting loss is very difficult for somebody to accept a loss. Maintaining a stop loss. I hear a lot of excuse from brokers, from traders saying that the broker can see my stop. So I'm going to keep a mental stop. I'm not going to place a stop on my account because the broker will run my stop. These are just excuses. If you are trading properly, if you have a plan and you do everything, you must keep a loss. You never know when a strong move can go against you, and it'll take a much larger loss. Hoping for a trade to come back, right? You're in a trade and you keep moving your stops, saying that, oh, it's just going against me and it's going to come back. That's the worst thing you can do. Trade goes against you, you have your stop loss in place. Take the stop, take the hit, get out of the trade, move on to the next trade. That's it. That discipline has to be there. You cannot wait for a trade to come back. It's going to make it worse. Revenge trading, right? I lose a trade. The next trade that I get into, I change my risk management policies because I want to recover some part of my trading. So I risk a little more of my amount. Oh, this trade is going to be good and I'm sure I'll make it. So I'll recover my losses. What if you don't? If you don't, you are risking more. Your account size is going to grow even much more, exponentially lower. So this is the mind factors you have to look at. Very important to go through all of these as part of your trading plan. And then the method, the last part of it, as we say, choose a trading system which is effective and which is easy to follow. Do some back testing on it. I mean, whatever system you may be following. Now, we follow Divergence, which is a primary trading technique. And this is effective because it is based on the concept that the institutional traders create traps for retail traders, right? If somebody makes money, somebody loses money. So how does an institutional trader who has the capacity to move price, who've got the amount of money to move price, they will move price to trap the retail traders. And this concept forms what we call as divergence. So in the divergence also, there are different classes of a divergence. There is a class A, there's a class B, there's a class C. We trade only the class A, which is one of the most effective, which is what the institutes tend to do, which is why it is effective. So I keep sharing this because this is a great example, a great picture of what the retail traders are doing. So you have price coming down to a support, and a lot of traders, when price comes back to the support, they'll tend to take a buy. Retail traders, as we call it, individual traders like you and me, and the professionals will drive price below that, because if I'm buying at a support, I have my stop loss somewhere below it, and boom, my all stops got taken out, right? So all the fish get caught in the net, as we talk about it. And this is what happens. So this is just one live trade which I had placed on. I managed to capture it. This was the divergence. So as you can see, this is a buy stop order that in case price goes up, I'd get filled into the trade. And this is exactly what happened. It went right to the target that we had marked. So our targets are based on advanced Fibonacci ratios. We identify the divergence as a class A divergence, which is created by the institutes. Our entries are based on advanced Fibonacci ratios. Our exits are based on that. Our trade management is based on certain tools that we use. So we have a trading system. The divergence is a trading technique by itself, a complete trading system, which includes all your rules. As you can see, this is a bearish divergence on, and you can use it on any market, any time frame. That's the best part about it. So you have a complete system which has your entry, your identification marks, your exits, your trade management, your risk management, everything built into it as a trade plan, one entire system by itself. All right, and this, I'm going to come back to this. So what we are doing is I am conducting a one-day workshop in London in this coming month. Today is the 1st of July. On the 16th of July, 2 weeks from now, one entire day, one class, trading divergence with the advanced Fibonacci ratios. As I said, complete trading system. How do you identify the correct divergences? How do you enter the trade? What Fibonacci's levels do you use? How do you exit a trade? What are your risk management policies for that particular trade? What are your trade management policies? If it goes in my favor, where do I take profits? If it goes against me, which it can I get out of it before I take a complete loss? Yes, you can. So all these things built up as a trade plan. Right, so if you want any more information on this, please have a look at this. If you are from that area, I would love for you to come over and attend the workshop. All right, for more information on any webinars, workshops, you can visit my website, go to all events and check out all the webinars that we conduct. For those of you who missed the money management part 1, you can catch it on this YouTube channel. I am part of this trading mindset podcast that they have over there. It's a nice podcast. You can just go there. They have some nice content over there. And like I said, if you want this document too, send me an email. I will email this entire document to you. These are our social media links. Please do follow it. All right, so good session. I hope this information does benefit you, and let's open it up now to some questions if you have any.